162.26. The yen is collapsing again, but the real story isn't the breakout. It's the trap sitting at 162.00 that's about to wreck the herd before the ISM data hits. There is one danger zone and one hidden opportunity right now, and I'll show you both. Stay to the end. I'm giving you 2 scalp plays and 1 swing trade you can execute today. This is Alpha Market Meridian, and we don't just watch the market. We front-run the next move. Here's the session bias. We are in a relentless uptrend on every single time frame, monthly, weekly, daily, 4-hour, 1-hour, all strong buy. That's not an opinion, that's the structure. But pure momentum without a pullback is exactly where intervention ghosts live. And the fundamental crack came overnight. The MUFG CEO explicitly warned that a persistently weak yen is now stifling domestic demand and threatening growth. That's not just a headline. It's a green light for verbal intervention. So I'm tagging today as a high-risk trending session with a violent, news-driven liquidity grab potential. Write this number down. If we break 161.33 today, the entire bullish structure resets. 161.33 is the daily S1 support. It's the pivot zone. It's the line in the sand. Below that, this breakout fails, and we slide into a multi-day correction. Above it, every dip is a buy until the BOJ steps in. The herd is overwhelmingly long, positioning for the breakout to 163, but extreme bullish sentiment and that MUFG warning create a crowded trade scenario. The smart money knows that when everyone leans one way, the trap gets set just above the obvious breakout level. That's where we are. Let me walk you through the chart from the top down, because this is a sequence you need to see with your own eyes. Starting on the weekly, the moving averages are perfectly stacked. The 5-week is above the 10, which is above the 20, above the 50, above the 100, above the 200. That 200-week moving average sits way down at 156.99, and we are trading 162.26. That's over 500 pips of premium. The trend is not just intact, it's accelerating. The weekly MACD is positive and signal line is curling higher, no bearish divergence. On the daily, we have the same bullish alignment, MA5 161.81, MA10 100 and 61.72, MA20 161.36, MA50 160.36, MA100 159.18, MA200 156.99. Price is above all of them, and the MA20 just crossed above the MA50 a few days ago, what some call a golden cross on the daily. Momentum is strong, ADX is at 56, which says trend strength is statistically extreme. That usually means we are trending, but pullbacks become sharper when they come because the rubber band is stretched. Now here's what most traders miss. Look at the daily pivot points. The pivot is 161.42. Resistance levels are 161.56, R2 100 and 61.65, R3 161.79. We are currently 162.26, which means we have already broken above the daily R3. This is a breakout of yesterday's range on strong volume expectations ahead of ISM. But the average true range is only 64 pips. We've already moved over 90 pips from yesterday's pivot, so we are extended. The CCI is at 84, not yet overbought, but the Williams percent R is at -89, deeply oversold on the intraday oscillator. That tells me the last hour or two have seen a furious burst of buying, and the rubber band is tight. When you break the daily R3 and sit there in an oversold condition on the short-term oscillator, what often follows is a vicious snapback to the R3 or even a 2 before the next leg. That is our trap zone, a pullback into 161.79 to 161.56 that will look like a reversal but is actually a gift for the next rip higher, unless the fundamental driver changes. Add cross-asset linkage. The US dollar index is edging higher, the US 10-year yield is ticking up ahead of ISM, widening the yield spread against the JGB. Bitcoin and Nasdaq futures are both green, risk on, which fuels the yen carry trade. So the macro current is supporting this breakout, but that same current can reverse violently if ISM misses and the dollar dumps. The next signal changes everything. Keep that 161.33 level in your mind. The core news of the last 24 hours is a double-barreled narrative. First, the MUFG CEO statement. He said weak yen inflation may stifle demand and threaten growth. This is a critical shift in the Japanese official discourse. For months, the narrative was that a weaker yen helps exporters and boosts corporate profits. But now the biggest bank in Japan is openly saying it hurts domestic consumption. That's a signal to the Ministry of Finance. The pain threshold is being reached. The intervention ghost is no longer just a rumor. It's being summoned by corporate Japan itself. Second, the yen resumed its slide as the dollar edged up ahead of the ISM Services PMI released due later today. If that number prints above 52, we are likely to see a rapid spike toward 163.00 as rate differential bets intensify. If it prints below 50, watch for a dollar dump that could drive US dollar to Japanese yen back into the 161.50 area in minutes on the cross-linkage. The US-Japan 10-year yield spread has blown out to the widest level in months, and that's the engine behind this move. When that spread widens, US dollar to Japanese yen goes up. It's almost a mathematical relationship. But here's the kicker. The yen's fall is now also being echoed by a rise in gold and a slight risk-on bid in equities, which tells you this is a dollar strength story, not just yen weakness. So if the dollar reverses on a poor ISM, the unwind will be brutal. My 1 to 2 week directional lean. I am structurally bullish above 161.33, with a target toward 164.00, but only if the intervention jawboning remains just talk. If the BOJ or MOF actually steps in, or if US data turns hard, we will test the 160.00 zone where the MA50 and MA100 cluster. The exact invalidation event, a daily close below 160.00 would kill the breakout and likely trigger a deeper correction into the 158.00 handle. Do you think the dollar breaks 165 this month? Comment yes or no right now. I'm tracking consensus and I'll pin the sharpest take. Most people skip this section. That's exactly where the money is made. Keep watching, because these are the exact entries I'm watching with my institutional screen in front of me. Strategy 1, the opening scalp, scalping, high probability, focus on the 15-minute structural retest of the broken daily R3 level. Here's the setup. After the initial spike, price begins to pull back. The level we want is 161.95 to 162.00. That's the psychological round number and the top of the prior consolidation. We wait for a 5-minute bullish engulfing candle that closes back above 162.00 after tapping 161.95. That's your trigger. Entry goes at 162.02 with a tight stop loss at 161.82. Exactly 20 pips below, beneath the R3 breakout point and below the 15-minute demand zone. Take profit 1 sits at 162.40, just below the session high, giving you a quick 38 pips, a 1 to 1.9 risk reward. If momentum is strong, take a second partial at 162.75. What instantly voids this scalp? If the 5-minute candle closes below 161.79. That would mean the breakout failed and the trapdoor is open. This is a scalper's dream, fast, clean, and aligned with the intraday trend. The opening SCLP entry, 162.02, 5M bullish engulfing after tapping 161.95 to 162.00, stop loss, 161.82 take profit 1, 162.40 take profit 2, 162.75 risk, reward, 1:1.9R, TP1, invalidation. Void if 5M candle closes below 161.79. Strategy 2, the liquidity grab, scalping, counter noise. This one is for the vultures. Every breakout attracts stops above the high, and market makers know it. The session high is currently around 162.30, maybe a tick higher. The play is a fake breakout, a stop run above 162.30 that gets immediately rejected. Here's how we trade it. Price pokes its head above 162.30, maybe prints 162.45, then a 1-minute bearish engulfing candle slams back down through 162.30. Entry is aggressive. Sell at 162.28 with a stop loss at 162.40, only 12 pips above, just beyond the wick. Target is the nearest intraday liquidity pool at 161.95. That's 33 pips down, a 1-minute and 2.7 seconds risk-reward. This is a fast trigger, requires quick execution, and works best in the 30 minutes before or after a major news event when stop runs are most likely. Warning: if price holds above 162.30 for more than 2 1-minute candles, the grab failed, get out. This scalp is purely a countertrend noise play, exploiting the intervention ghost fear that makes longs nervous at the top to the liquidity grab entry, 162.28, after spike above 162.30 and 1M bearish engulfing, stop loss, 162.40 take profit, 161.95 risk, reward, 1:2.7 are invalidation. Void if price sustains above 162.30 for 2 1M candles. You scalping or swinging this week? Comment scalp or swing right now. I want to see where this community sits, because the market feeds on the imbalance. Strategy 3, the session swing, trend alignment. Now for the core swing setup that aligns with the daily and 4-hour bullish structure, but respects the stretched nature of the move. We are not chasing at 162.26. We wait for a pullback into the high probability support cluster between 161.56, R2, and 161.33, S1 pivot. That's a 23 pip zone where the daily MA20 and the breakout retest intersect. The trigger, a 4-hour candle close above the MA20, which is at 161.36, but we are already above it. So realistically we need a pullback that holds 161.50 and then a 4-hour closeback above 162.00 to confirm the swing. So a limit order at 161.55 is ideal. Stop loss sits at 160.85, just below the weekly pivot and the S3 zone, giving the trade room to breathe, 70 pips of risk. Take profit 1 is the round number 163.00. A level we haven't hit yet but is the next psychological magnet. That's 145 pips, giving a 1:2 risk reward. Take profit 2 extends to 164.50, the 2026 yearly high projection. Once price trades through 162.50, move stop loss to break even. This swing is designed to capture the next leg of the yield-driven carry trade, while keeping you safe from an intervention whipsaw. Invalidation. A daily close below 161.00 would suggest the structure has broken and the swing is no longer valid. The session SWNG entry, 161.55, limit order, stop loss, 160.85 take profit 1, 163.00 take profit 2, 164.50 risk, reward, 1:2.0 R, to TP1, 1:4.2 R, to TP2, invalidation. Daily close below 161.00 never risk more than 1 to 2% per trade. On scalps, I cut that even tighter, 0.5% maximum. Do not hold positions through high-impact news unless you've reduced size and widened stops accordingly. Stops are non-negotiable. A mental stop is not a stop. That's how you survive to trade the next big move when the intervention headline really hits. The single most critical level for the next session is 161.33. If we close below that, the breakout is dead and a retest of 160.00 becomes the base case. Tomorrow I'll break down the ISM aftermath and the post-news structural reset, because if 163 breaks with force, the monthly trend flips to target 170 in the long run, intervention be damned. That updated blueprint drops 24 hours from now, with exact levels refined by the new data. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Tap the end screen on your screen. Then hit the bell so tomorrow's alert lands before the open. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that matter.